My name is Laurie Norman, and I'm an investor specialist and partner in the Vancouver office. I'm one of 7 on our client team, and we're primarily the ones that give you guidance and advice on your portfolio. We're usually the ones that you first speak with or meet at Steadyhand, and also the ones that hopefully you build relationships with over time. So the conversations that myself and my colleagues have had with many of you over the past few months have been entirely opposite to those we had this time last year. They're more upbeat and optimistic and way less performance focused. 2019 was a really good year and pretty much polar opposite to what we all experienced in 2018. The markets were up and so were our returns. But even with all of the positive market news, the fact is trade and politics and climate change and other world events like the coronavirus really took their fair share of the headlines last year. And for many of us, this can impact our emotions and also impact how we feel about our portfolios. They definitely kept Tom, Salman, and our managers busy, and you'll hear from them shortly on how they navigate through some of these issues when they make investment decisions on your behalf. The markets and politics and economics, that wasn't just what kept us busy last year. Something we think about every day at Steadyhand is how can we continue to improve upon and build an exceptional client experience for all of you. And we were hard at work on that this year. In our investment lineup, we introduced 2 new funds and 1 new manager, which we spoke about last year. And with a focus on improving your online experience with us, we launched a new online portal and reporting system in November. Based on the calls we've had and the number of password resets we helped with, we know this directly impacted all of you, so thank you for your patience as we've transitioned to the new system and the time that many of you already taken to provide us with feedback. With the launch of the new portal, we now show you how your portfolio is done in dollar terms after fees, and we've added a section on performance, which previously was only available to you in your quarterly statement. Though these may seem like small changes, they've allowed us to deliver full transparency in your performance, and this is exciting for us, also lay the foundation, so over time we can hopefully add more online tools and enhancements to make it easier for you to make decisions around your money. What hasn't changed this year is Steadyhanders continue to invest alongside all of you, with 92% of our family's financial wealth invested in Steadyhand funds. We also pay the same fee as our clients. There is no employee discount. We continue to grow in 2019, primarily by way of introductions from all of you. Your confidence that you've shown in us and your willingness to introduce us to your family and your friends and your business colleagues is enormously appreciated by us. It's how we built Steadyhand and how we will continue to build Steadyhand, one client at a time. And lastly, the average fee paid by Steadyhand clients has remained below 1%, and this is the all-in fee, as 472 of our clients joined the 5 and 10-year club in 2019. I was one of them. Just out of curiosity, how many of you are in the 5 and 10-year club? Okay, that's like almost half. That's really cool. That's cool. So as a reminder, clients of Steadyhand enjoy a reduced fee of 7% when they've been with us for 5 years and another 7% when they've been with us at their 10-year anniversary. Remarkably, we are the only investment advisory firm in Canada that rewards long-term investors. So moving away from inside Steadyhand, for the balance of the presentation, we're going to take a deeper dive into the year we've had and a look ahead into 2020 and beyond. Tom will begin the presentation by returning to the foundation and investing principles of Steadyhand. Salman will take you through the fund's performance and talk about an issue that we're all dealing with daily, which is climate change. And you'll also hear from 2 of our managers on their own investment philosophies, and they'll highlight a few of the companies they own within our funds. Tom will return to discuss how we're positioned in our funds and advice going forward. I will close the presentation touching very briefly on how we work with clients, and then we will open it up for questions.
With the change of title for Neil, my title was changed too. I'm now chair and chief investment officer, and I kind of like this gig. It's good. But as with Neil, my role isn't changing either. I'm a very lucky guy. We have a strong team, and it really allows me to be a bit of a prima donna, frankly. I get to do exactly what I want to do, which is, geek out on investment research, and which feeds into the management of the Founders Fund, meet with many of you, meet with clients from time to time, and then pursue my passion of writing and educating. So, as I say, I'm a very lucky guy. We thought maybe to start on the foundations, maybe start where Neil and I were discussing how Steadyhand would work, which was on Kitts Beach in the summer of '06. And we thought this year was important that we kind of reaffirm our vows with you, because it's crazy out there. There's so much going on, and we hear it through the phones and in the meetings with you, but who knows how politics works anymore? Interest rates, are they just going to keep going down? How much debt can society support? And in the case of investing, it never ceases to amaze me. About every year, investors right now at this point of the cycle fall in love with some bright, shiny object. It might be Bitcoin, might be cannabis, might be a really cool, growing, emerging company that has no sign of profits anywhere in the future. So we just thought it was a good time to touch on this, as we say, foundation. Now, Laurie's touched on one aspect of it, what we call our business practices. So we want to be transparent with you, and I think you'd agree that we are. Charge a low fee, that 92% co-investment, and of course, when you need it, be your steady hand. Today, I'm going to just spend a few minutes talking about the other side of our foundation, which is how we invest. And everything I'm going to tell you has been designed from, probably on the beach, on a fresh sheet of paper, to try and create returns that will be attractive over the course of many cycles, the ups and downs that we all go through. We're active managers, so we concentrate on the holdings we really like. We discriminate as opposed to owning everything. So we're undexers as opposed to indexers. But to be clear, very much our goal is to beat those indexes over the course of a full cycle after you've paid your fees, and Salman will talk about that. So how do we do it? Well, I'm going to break it into 3 steps. First step is we identify companies that we want to own, companies that we can live with for a long time if we have to. And so we get out our magnifying glass, we comb over numbers, we burn up shoe leather traveling the world, trying to find companies that have enduring value, are well-financed, they're growing, and in most cases have an income stream in the form of a dividend. This is the fun part. As an old analyst, and you can tell I still have it in my bones, this is the fun part, is finding these little gems. And when you hear Joe and Magnus a little later, you'll know what I mean. The second part's more of a grind, and it's maybe even more important, and that is valuing these companies. What are they actually worth? Because that is the most important factor in generating returns for your portfolio, is buying assets at a good price. And so we want to own the ones that, if we think they're worth $1, we're buying them at 70 or 80 cents, not at $1.10 or $1.20. Let me give you an example. Fictitious company XYZ, one of our managers has done an assessment, and that blue line is their assessment of how value in that company is going to grow over time. Now, of course, if we project forward and lay the stock price over that, lo and behold, it's way more volatile than that value line that we've assessed. It creates opportunities to buy, the red circles here, and the converse of that would be sell when it gets overvalued from time to time. Now, you might say, why doesn't it just trade on the blue band? And you've got to remember, though, that is our opinion of how that company will progress. And we might think, for instance, that it has more potential than other investors think. We might be taking a longer time frame. Market loves to sort of get into its what have you done for me lately mode and really hammer stocks if they have a lousy quarter or miss a product launch or something like that. So we're quite happy to take advantage of that. And of course, something we're going to talk about today a couple of times actually is sometimes companies just aren't sexy enough. They're not growing fast enough. And right now we're in a market where it loves growth. It'll go for growth at almost any cost, that bright shiny object I talked about. So Sometimes that allows us to find a little red circle that I showed you for a perfectly good company at a really good value. Final piece is putting it all together. So portfolio, what we call portfolio construction, fitting all of those assets together so that we have a cohesive portfolio. And as you've heard, our holy grail is finding things that have lots of upside, but very little downside. But we have to balance that off the fact that sometimes we're going to be wrong. We'll just get it flat out wrong on a stock, or our thesis will take a lot longer to play out than we thought. And importantly, we don't want our portfolio to all be hinging on one or two factors, like an economic factor like interest rates, or a trend in the market like blockchain or cloud computing or something like that. So we have to diversify across the types of assets we own, cash bond stocks, certainly for balanced clients at least. When we own bonds, we want to diversify across who's issuing these bonds to us, from governments, corporations. On the equity side, you're going to hear a lot about this in a minute, different industry sectors that are driven by different economic forces that affect them. And then finally, different geographies and currencies. Now, we talk about diversification a lot, and I'm sure a few of you sometimes say, like, it's not always obvious why there's such benefits. Markets sometimes get driven by just a few forces for a period of time. If you said to me, Tom, I just want US blue chip stocks and Canadian banks, I don't want all that other stuff. I'd understand where you're coming from. They've done very well. But I'd have to say that virtually all of us are in this for a much longer period, which will extend over many cycles. Each cycle's different. Each cycle has different phases to it. And so our goal here in doing these 3 steps is really building a portfolio for all seasons. So if it isn't quite as hot in the summer as we'd like it, we want to make sure it gets you through the winter for sure.
Earlier on, Tom referenced that our goal was to beat the markets over a cycle using the philosophy that he's just described. And I'm happy to say we've done that. 4 of the 5 funds we launched with almost 13 years ago have beaten their benchmarks and rank among the top 25% in their peer groups. That's what's known as being top quartile. Our 10-year numbers are even better, but we prefer to focus on the since inception number because it is full cycle. It includes the depths of the financial crisis from 2007 to 2009, and then the subsequent market rally. Now, for that one fund that hasn't done well enough, the Global Equity Fund, well, we addressed that issue 18 months ago by replacing the manager on that fund. But because we build diversified portfolios, you, our clients, have still experienced strong returns. Most of you in the room here are balanced clients. You own a mix of stocks and fixed income. And a typical Steadyhand client has a portfolio of 60% stocks and 40% fixed income. This mix, since March 2007, has returned 5.7% per year on average after fees. Said another way, this mix has almost doubled in a period that includes one of the most dramatic market meltdowns ever. That too is ahead of most peers. In 2019, this mix, which investors can now get through the Founders Fund, returned 11.6% after fees. And just as a reminder, the Founders Fund gets to its target mix by investing across our lineup of funds. It's what's known as a fund of funds. And each of these underlying funds had a positive year last year. All of our equity funds were up double digits. And despite being our more conservative option, even our income fund was up more than 9%. And you'll recall last year we launched our Global Small Cap Fund. Well, it doesn't have 1 year of history under its belt yet, so we can't actually show you performance, but we can tell you if you ask us directly. So if you see someone with a name tag afterwards, please do ask us. We'd love to share it with you. And we're going to talk to the manager of that fund, Magnus, in a few moments as well. As good as these numbers are, 2 of our funds, our equity fund and our global equity fund, did not keep up with markets in 2019 specifically. This was a year where Canadian and global markets were up more than 20%. And they were driven by 2 industries, gold and technology. And we own companies in both these industries, but we've just been more selective here. In gold, there are few companies our managers think can sustain profits for very long periods. And in technology, our managers have struggled to find companies that can be bought at reasonable prices relative to their profits. This too is a topic we're going to touch on in a few moments. Of course, we expect there to be trends that drive markets from year to year. Last year was gold technology. A couple of years ago, it was cryptocurrency and cannabis. And because of that, we expect to be average and even below average over shorter periods. In fact, those great long-term results I showed you earlier, those are comprised of many shorter periods in which we were mediocre. And over the last 3-4 years, we've been average. And we're not in this to be average. But what we also expect, and indeed what you've experienced, is that sticking to that discipline of investing in a diversified portfolio of companies that might be unloved or underappreciated is key to growing your wealth over your horizon, which for most of you is longer term. Even those of you in retirement, those of you drawing from your portfolios are going to be invested for more than 10, 20, 30 years. Now, there is a great side effect to having so much attention paid to just a couple of industries. There's lots of opportunities elsewhere. And our managers have found those opportunities in overlooked areas like industrials, financials, healthcare, and oil and gas. These 4 industries today account for the largest part of our Founders Fund stock holdings, and for that matter, for our Builders Fund as well, which is a one-stop solution we launched for our growth-oriented clients last year. Before I get into specifics on these, especially specifics on oil and gas, I want to address something that's on many people's minds, and that is climate change. Now, this is an issue that many of you have asked us about, and at Steadyhand, I've been involved in guiding us on what we need to be doing to address this crisis. And I got to tell you, it's been one of the hardest things we've worked on as a company. The trade-offs of various decisions are not always obvious unless you do a lot of research, and what often seems black or white is mostly gray. And I had a personal experience with this on a recent trip I made. My parents are from Pakistan. I had a chance to visit last year, took my wife and daughter for their first visit. Now, the people of Pakistan face a dilemma. The country produces less than 1% of global greenhouse gas emissions, but the country ranks among the 10 most directly impacted by climate change. Landscape is changing fast, and it's a big deal because it's still an agriculture-based economy. They now have a dedicated ministry of climate change. But Pakistan is also a very poor country. It ranks 132nd on income per person. We in Canada rank 22nd. So to lift its people out of poverty, the government is launching all these initiatives for businesses and industries. But the challenge is electricity. You need power for development. And the cheapest source of electricity in Pakistan comes from natural gas and coal, which it has tons of. So when you ask locals, to them, the choice is obvious. They'll all tell you the social issue is far more pressing than the environmental issue. A line I kept on hearing over and over again during my trip was, yeah, we know we need to address climate change for our kids' futures, but for our kids to have any future at all, we need fossil fuels today. And you don't have to go to Pakistan or Alberta or West Virginia to see these things playing out. It's happening with billions of people around the world are trying to grapple with this challenge. Now, at Steadyhand, we realize there is no perfect solution to this, but we are looking at what we can do to address some of these trade-offs. As with many things at Steadyhand, with us, it starts with transparency, and we're enhancing our reporting to include how environmental, social, and governance issues impact the holdings in your portfolios. Being an investor in companies also gives us a unique opportunity. We can engage with companies. We can talk to executives directly. We can vote on proposals that investors or that companies are thinking about. And so we're asking our managers to engage with companies on issues like working conditions, compensation, and of course, climate. I can also tell you that all our managers today assess environmental, social, and governance risks before investing in any of the stocks or bonds in your portfolio. This is what's known as ESG, environmental, social, governance. And we're going to talk to a couple of managers specifically on how they do that. But they're long-term investors. When you're a long-term investor, you have to take all these issues into account. But these issues are also evolving and growing. And as they are, our managers are weighing them differently. Political, litigation, and these types of risks are real. And this is important because they want to make sure they're investing in companies for decades, that will last decades, and not just companies that might last a year or two. Now, energy specifically, this has meant that we're investing in companies that are needed today, but have shown a willingness to transition for the future. One of our larger holdings is Suncor, and Suncor is an energy producer, but is also a leader in reducing the intensity of its carbon outputs. It's used as an example of what the oil patch needs to be doing to evolve. But we've also seen an opportunity in renewables. Northland Power is a holding in our small cap equity fund, and Northland is the largest independent renewable energy producer in Canada. The common theme in a lot of our holdings, including these energy ones and ones in other industries, is that they stand to benefit from two trends that Tom talked about last year: an expanding middle class and an aging population. These are trends that continue to gain momentum, and it's probably most apparent in healthcare. This is an area where all of our managers have bought stocks recently. Our equity manager, Fiera, recently purchased Philips. Many of us know Philips for light bulbs, but it's actually a leading manufacturer in diagnostic equipment like X-ray machines and MRI machines. And the largest holding in our global equity fund is Zimmer Biomet. Zimmer is a leader in artificial knees and hips. And make no mistake, these companies aren't sexy. Anyone who's been in an MRI machine knows it's not fun, it's not sexy. But they all make profits, and they all have growth opportunities that will last well into the future. But most important, they've all been bought using the same principles that have driven our returns in the past and that will drive our returns in the future. So let's get into more specifics. We've got a couple of managers here. I want to start by introducing the manager of our small cap equity fund, Joe Sertivan. Joe is a founder of Galibier Capital, which has been managing this fund, our small cap equity fund, since the fall of 2016. And since September 2016, since the fund was transitioned to Galibier, the fund has returned a cumulative rate of 28%. And over that same period, the Canadian small cap index is up 0.4. So quite a big difference there. Shorter term, but still good performance. Good to see you again. Joe, take our investors through how you achieve your performance, how you build your portfolios, your process.
Okay, so how do we manage money? Okay, so I'll be very succinct. We are, simply put, valuation-driven, bottom-up stock pickers. We do two things in supporting that investment philosophy. We define an investable universe of names that meet 5 very specific criteria, the most important being an enduring competitive advantage and that have strong ESG practices. We'll get into that in some detail a little bit later on. For a company to be in our investable universe, it has to have all 5 of these criteria met. We cover about 125 companies in Canada and about 250 globally, and we draw on that for your portfolio, for the Steadyhand small cap portfolio. The second thing we do after we define that investment universe, and this is really Galibier's secret sauce, is we proactively value all those companies. And to do that, we look out 3 to 5 years. We calculate future earnings power of the company and how its balance sheet is going to evolve. We model that out and we strike a value. And then we discount that back at a very high hurdle rate of between 12 and 15% to define intrinsic value today. So you say CNR, and I say 126, and you say Loblaws, and I say $68. That's our view in intrinsic. The trick, however, is that the market doesn't price stocks exactly efficiently. So we're seeking for that discrepancy between our estimate of value and market price. And we run very concentrated portfolios. We try to have around 25 names in the Steadyhand fund, and we're looking for the 25 best ideas that meet those criteria on any given day. Let's talk about OSHKOSH. So this is a U.S. company. It's a specialty truck manufacturer. It makes fire engines. It makes cement trucks. It makes actually lifting platforms. You see the JLG lifting platforms all over the place. They have number 1 or number 2 market share globally in all of these products. They're a very efficient manufacturer, and their competitive advantage really comes from deep and entrenched customer relationships and very high returns on invested capital due to their very integrated manufacturing procedures and the fact that they leverage their R&D across all these specialty truck lines. So this is a very cheap stock, and let me just maybe describe to you after we've talked a little bit about we'll talk a little bit of valuation. I mean, this stock right now it trades around $92. We bought it for you at around $67, and when we bought it at $67, it has about $12.50 of net working capital, so cash, less all the debt on its balance sheet still has $12.50 per share. And then we have a company that makes about $8 a share, and free cash flows, or after spending all the needs for its growth, still cash flows about $8 a year as well. So if we look out 5 years, we have a company with $8 in earnings power. We have about $28 a share in cash. And if we were to value that, we come up with fair value today around $82. So we bought it for you at $67. I think we had about a 5% weight in the fund. And now it's at 92. We've been selling down our position a little bit and then taking that cash and redeploying it into higher potential names because it's well above our estimate of intrinsic value. So that's OSHKOSH in a nutshell.
Earlier on, I talked about environmental social governance. I promised the crowd that our managers would talk about it as well. It's been a part of your process for your entire career, so why don't you expand on that?
Exactly. It's absolutely essential, and it's baked into our DNA. Now, I used to work at Ontario Teachers and also as a Jaroslawski Fraser for many years, and we are, those two entities, the co-founders of the Canadian Coalition for Good Governance. So governance and environmental and societal factors are baked into the DNA, and that continues at Galibier, even more so today. We also, about 95% of our assets under management are for institutions that demand us to be good stewards of their capital. And finally, and this is most important, remember we talked about those 5 criteria and an enduring competitive advantage or a sustainable competitive advantage. And in our view, a sustainable competitive advantage only is available to companies that are following strong environmental practices because eventually there will be regulation or some pricing of carbon or some pricing of externalities or this impact on public goods. And we believe that the companies we have in our portfolio right now will not be affected that. They have durable competitive advantages. So part of our process, it's explicitly mentioned in our investment analysis work, and we will, I guess, a couple other factors that support that. We are signatories to the UNPRI, and we do pay a significant amount of money for consulting services from Sustainalytics that gives us a good view on the environmental practices of all of the companies in our investable universe.
So governance is particularly important for one of the holdings, a stock you recently purchased last year, SNC-Lavalin. Tell us first when you bought it, and tell us when you bought it and how you got over some of those governance challenges that the company might face. But maybe let's just start with a sentence on what it does.
Okay, so SNC is one of the world's largest engineering and construction companies, and actually it's in the process of reducing its construction exposure and just focusing on its engineering business, particularly in power and particularly nuclear power, but nuclear remediation. So actually a very necessary and profitable area of expertise. It also has, the stock trades today for around $32. We bought it for you at $17.50, I believe, back in the summertime. And SNC also owns about 7% of this major toll road in Ontario called the 407, and a number of other infrastructure projects around the world, which are worth demonstrably about $13 a share. So when we bought it for you at $17.50, we take $17.50 and take the $13 off. That gets us $4.50 in value to buy about $1.60 per share in earnings, going to probably $2 in its engineering business. But the stock sold off and sold off and sold off because of concerns in the market about a bit of a political brouhaha, the details of which aren't important, except that we had to make sure that they weren't important. And to do that, we analyzed the company. We looked at the issues, which were primarily to do with a very serious transgression they made with respect to bribery in Libya about 10 years ago. And we quantified that, we quantified the risk, and we flew down to Montreal and had a meeting with the CFO and verified that that was the only kind of issue that the company was facing. And once we felt that was going to be remediated, we acted and bought the stock, and our estimate on fair value was about $26. At 32, actually, we've been trimming the stock again, so kind of like OSHKOSH, it's been a very good performer. We're taking some money, harvesting money out of that and putting it into other ideas.
We'll leave it there. Thank you, Joe. Joe's going to be here. Thank you. Joe will be back here once we conclude the presentation to address any questions you might have, and he'll be outside afterwards too if you want to talk to him directly. The next manager I'm going to invite on is Magnus Larsson. So Magnus manages our Global Small Cap Fund, which is a fund we launched last year. When we started researching this area, one thing that became apparent very quickly was that it requires a fair bit of resources and a fair bit of expertise. And so when we went on, we wanted to find a specialist to do this. And Magnus has dedicated the his entire 20-plus year career to managing small cap companies around the world. But Magnus, this global small cap is a quirky asset class. It's an interesting, it has a lot of potential for returns, but it takes a lot of work to get those returns. So tell us how you overcome that challenge.
Absolutely, and thank you so much for having me here. It's a tough act to follow. Joe, Saman, Tom, it's a little bit daunting, so I'm a little bit nervous, but I'll do my best. Yeah, so the way we go about this is really starting with the team. Everyone in the firm is really experienced and done this for our whole careers. And we're a bit unusual in the sense of our people are actually coming from the very markets where we invest. So we have, it's a quirky mix of people. I'm Swedish, we have a Turk, we have a Frenchman, we have, David O there, I don't even know what to call him. He's half Korean, half Chinese, and born in Brazil. But more importantly, so we have all these people. We even have Americans, believe it or not.
Based in New York, by the way.
We're based in New York. Times Square Capital. It's be no surprise to let you know that that's our actual office, 7 Times Square. Pop in, we got a great view. But that's kind of the secret, going out there, traveling the real world, because in small cap investing, you actually have access to these companies in a whole different way than you would have with the Googles or the Siemens or those big global corporations. If I was to call up Siemens and say, hey, I'm coming to Munich, can I meet the management? And they would probably say something like, you can meet the junior investor relations guy in November 21. Whereas in my universe, me and my team, we can literally call up any company anywhere in the world and say, hey, we really want to come and see you. And they said, absolutely, come and see us. So that's what we do. We rack up, and I know that in terms of flying, we spend maybe too many air miles, but we try to do it in a conscious way. But what is so specific about this asset class? So you all know this very important, the Siemens I just talked about. They're covered by so many analysts, and because this is where the big money is for the broker firms. And when you look at the difference between the world's global guys and the world's small cap, not only do we have much more, space there, we have so many more companies not even covered at all, and the average coverage is less. And on top of that, and this is the real beauty, not only are, there are fewer analysts on the sell side covering this, they tend to be much more junior. Because what happens in the big world is that normally an analyst joins after college, they put her or him on small caps, and once this person proves themselves, they get moved to the big guys. Which means that it's left really to me and my peers to compete with very junior people, and I like that. Don't tell the investment bank to change. Keep it that way. It's wonderful.
So how tell us about the process that you use to unearth some of these, this needle in a haystack.
Absolutely. So it all starts with us going out there, and like I said, we have people from these very markets and these countries and regions, and we have a wonderful network. Since we all have lived and worked and grown up with these, we have a network of people on the ground. Some big firms will tell you, we have tons of feet on the ground. Well, we have built a network over the last number of decades that will be pretty much impossible to replicate unless you also take a couple of decades of doing that. So we travel out there using our local resources, trying to identify truly outstanding companies. For us, finding greatness. So we are in the very high quality space. That's a starting point. Finding companies that are well managed, have strong balance sheets, and yes, come back to sustainability, a very sustainable business model. So the first important thing is actually finding the right companies. Only when we have identified these companies and met and studied their supply chain, their value chain, only then do we really do any deeper financial analysis. Because our view is that if we don't understand where the numbers are coming from, we can't really use those numbers. So you should see this very much as a step change of first finding excellence, then trying to find the value, and if it's not attractive enough, because we're very conscious of valuation, we just wait. We're very patient. Then we move on to portfolio construction. This is almost a little bit automatic in the sense of if you buy best-in-class companies, you can't end up with a whole cluster of companies doing the same thing. You know, I even invented a name for it. I call it the Highlander rule. If you remember that old movie with Christopher Lambert, there can be only one. And it works. It gives you a very high diversification, which means that there's very little that can happen in the world that will impact the whole portfolio. Sure, things we had spoken about, the coronavirus, we're not particularly bothered for the portfolio, we're bothered for people's safety, of course. But regardless of what happened, there's an election, there's a Brexit. You know, who would have thought? I put 0 probability of Brexit, and it still happened. So don't ask me about the outcome. And my wife is British as well. So that is kind of the flow of what we do.
One of the things we talked about quite a bit when we were hiring you was, and that we liked, was that environmental, social, and governance was just baked into the process. We didn't want it to be a separate thing that you did on the side. We want it to be built in. So maybe just in a minute, tell us how you do that.
Absolutely. So, to put it separately and I put a nice little label and call it ESG, that might be good for some marketing, but it doesn't work in the real world where real people live and work. So when we assess a company, we need to look at all the stakeholders of a company. You know, if you mistreat your employees, you will have a big difficulty. It's costly to hire, to find talent, to keep them. So you need to take care of them. If you are messing with the environment, well, look at BP in Macondo. Time flies. It's been close to a decade now. That accident could not have happened in Europe because European regulation says you need a safety valve. It costs about $50,000. But in US waters, you didn't have it, so they skipped on it. Not a very good idea. You know, if you abuse your suppliers, you end up like the car industry. They abuse their suppliers for decades, every year, pushing. And now we actually find a lot of opportunities there because the suppliers, in order to survive, had to become so efficient and so consolidated that they have the pricing power. And regulators, if you misbehave, so it's something that's built in. So we see it in a very much holistic way that a company needs to be at least fair to all its stakeholders.
You had an example that you were telling me about earlier. Maybe just take us through very briefly.
Yes, so this is actually a most recent addition to the portfolio. And just to put things in perspective, when you hear about ESG, and you might have certain pictures, and I would tell you that our most recent addition to the portfolio is a British company that is probably one of the highest energy emitters per employee in Europe. They are hugely energy intensive. They only have 25% of management at different levels are women. Less than 40% of the board are women, and you start thinking, that doesn't sound very good. I mean, really? I mean, why would you invest in that? Well, let's take a step back here and see. Bodycote is the world leader in heat treatment of steel. So yes, they emit a lot of energy treating the steel, but by doing that, they can extend the lifetime of these components that goes into jet engines and what have you, up to 20 times. So yes, in isolation, they use a lot of energy. But if you look at the whole value chain, they save tons of energy. And looking at the female issue, well, their whole workforce, 17% are women. So the fact that 25% of managers and 40% of the board are women means that they're not holding back women, they're actually promoting them more. So this is just a picture of you have this idea that, it sounds bad, but when you drill deeper into understanding the business, you realize that this is where the opportunities are and a lot of the misconceptions out there. So to just slap ESG and say, hey, we're economically, environmentally friendly, it's not enough. It needs to be core of it.
One of the, moving on for a second, something we talked about earlier is the difficulty our managers have had in finding technology companies because they're they're very expensive. About 20% of the global small cap fund is invested in technology, but the technology that you own is quite a bit different.
Absolutely. So you have this idea of a tech company, and people think the FANGs, Facebook, Apple, Google, these things. And in the small cap area, I call them the FANG offsprings. You know, they are not profitable. They probably won't be ever, or a very long time away. So this is kind of ideas of, oh, you have a lot of tech, that's risky. We are call it the other side of technology. One of our big holdings, Nordic Entertainment, has transformed itself from being a very mundane broadcaster of free-to-air TV, linear TV. This is what people are not watching anymore. But by investing in technology and leading, these guys were Netflix in Nordics 10 years before Netflix. Gotta say, the Americans were a bit slower than our Swedes on that one. So the market values these guys still as a normal TV advertising-driven company because they put them into boxes. And that's another thing that the market likes to do, put things into a box. And when companies are taking a step out of that box, the market sometimes just doesn't get it for a while. So this is a company that saw what happened way before it actually happened and dealt with it. And it's very consistent, and they made a fantastic deal. Do we have any Norwegians in the audience? I don't want to offend anyone as a Swede. Okay, so we got one. So they actually last year made a deal with Telenor to have a joint venture where they put call it the physical assets, the satellite dishes, the cables, the boxes, and all of that. And it's a 50-50 venture. But Nordic Entertainment were 60% smaller than Telenor. So I think it's a great deal. So now you have basically, they are Netflix, and they are ESPN. They have all the sports rights, and they create their own content. So this is just a good example of a company that's transformed themselves by using technology. So it doesn't have to be Facebook to be technology. There are many other uses, and there's tremendous opportunities in the small cap space for this.
We'll leave it there, Magnus. Thank you very much. Okay, sure. So Magnus and Joe, like I said, will be here afterwards. And also, we shot videos with both of them and all of our other managers over the last couple of weeks, and we're going to be releasing those videos in the coming few weeks so that you can hear not just from Joe and Magnus, but from our other managers on how they're investing today. So you've heard specifics about our funds and what they're holding, and now it's time to put it all together to see how your funds how your portfolios are going to deal with some of these challenges and opportunities that these folks have talked about. And for that, I'm going to hand it back to Tom.
So we've thrown a lot at you tonight, and with the two managers, hopefully you've sensed their passion, but it's pretty dense. We've thrown a lot at you, and many of you came to hear us talk about some other things. These are issues that we hear through the phone, we hear in client meetings, that you care about, and you're wondering how it affects your portfolio. And so I thought what I'd do as we sort of roll into giving you some specifics on our strategy is talk how we deal with these issues in the context of that process I took you through before. And you have to have gathered by now from me, from Saman, from Joe and Magnus, that we think the best way to generate those returns for you is focusing on companies, what we call bottom up, as opposed to trying to get ahead of some of these issues, economics, politics, etc. But you might say, why don't we do both? And I think I've been at it 36 years, and my experience tells me a few things. One is that there's always something. There's always something the market obsesses about. And sometimes it's important, but a lot of times it isn't. But the key is that they're really hard to predict what that next item is going to be, and even harder to predict how it impacts stock and bond prices. And so it is very, very difficult. The main thing, though, is when we've done a lot of analysis, particularly, on politics and economics, it seems to have very little impact on the long-term value of the companies we own. And we've talked incessantly about that tonight with the managers, what we're trying to do in valuing companies, and the kinds of issues that we read about every day, and they're on the national, just don't impact the value of our companies. So the threat is worse than the reality. Let's look at a couple of those issues. Politics. Project back, I know you don't want to, but project back to the fall of 2016. Trump's just elected. We're 5 months after the Brexit vote. And polls said, and our informal polls with many of you would have suggested that markets aren't going to be very good for a while because we're going to have political turmoil. Well, we had that political turmoil, but look what the markets have done. The threat was worse than the reality. Trade has been the same. The Canada-US agreement, a lot of hyperbole, a lot of headlines, a lot of hysteria, and yet here we are just about to ratify that agreement, and the stocks that did get bounced around a little in that process are back to where they were before or higher, and we're moving on. The third one that you've asked us about and is on many of your minds is recession, and this one's different than the other two. When we have a recession, and we will, jobs will be lost, corporate profits will go from profit to loss, and stocks will go down. But there's a few things to know about recessions. One is they're not to be avoided, even though politicians or commentators might tell us we can, because it's caused by there's one main cause to recessions. It's the expansion and the contraction of the use of debt. Think about it. In good times, bankers just shovel money at you. They want you to have that line of credit or that mortgage, and it's the same for corporations. But when they make a few mistakes and they go too far, they turn the tap off, what happens? The economic activity shrinks, and indeed we have slowdowns or recessions. The other thing about recessions is they're really hard to predict. It's a bit of a theme I've had tonight on these kind of issues, but it's true. It's really hard to predict when we have governments all around the world intent on kicking the can down the road. And what I mean by that is they don't want to get to they don't want a recession before the next election. So what do? Well, they use the two main tools they have. They use monetary policy, keep rates really low, even negative in some parts of the world. And they use fiscal policy, spend some money to create economic activity. Money they generally don't have, but we just take the bill and pass it on to the next generation. So that makes it really hard to recession-proof your portfolio. And many of you have asked, how do I do that? We think it's very tough. We're going to talk about some of our themes and our strategies in a minute, but think about it. If you miss that recession call for a year, 2, 3, 4 years, which is easily possible, given what I've just said, you can miss a whole whack of returns that you'll never get back. And so we think it, as much as we should worry about it, because it will happen, we don't think you can go there and prepare for it. So to be clear, on some of these issues that are really weighing on many of us, I'm not trying to be dismissive, but we really have to be discriminating on how we factor those things into that investment process you've heard a lot about tonight. And we generally won't avoid them. We'll get sideswiped by something that suddenly hits the front pages, but you can count on us that if there is dislocation, if there is overreaction, people like Magnus and Joe and their teams will react. So let's take those three issues, and we've talked about climate and the virus earlier. Let's bring that all together, and I'm going to sort of sum up what we're doing in three themes. And you've heard a lot of the sort of the micro, but let me give you sort of a bit of an overview. Our first theme is Sam is your friend. Now, some of you are going to groan because you hear about us all the time. We talk about SAM. So SAM is your strategic asset mix. It's that mix of assets that you build your portfolio and hold for the long term. Why do we focus on it so much? Because it is the biggest dial on your dashboard. If you want to dial up risk or dial down risk or return, it's the biggest thing you have. There are other tools, but this is by far the greatest. And so when we think about our portfolios, and specifically the Founders Fund, it has a SAM too. 60% stocks, 40% bonds. So theme number one, when I say SAM is your friend, is we think right now our equity weighting should be just right on our SAM. Some of you know, if you've followed us closely, know that we sometimes dial it up, dial it down, depending on circumstances. But today, the major factor that we follow, valuation, would say that markets aren't overly expensive, but they're not overly cheap either. So this chart is one we've used in these sessions for really 12 years now. It compares the price of a stock to how much it earns, or what we call a PE ratio. This happens to be 1,700 stocks. And This is why markets bounce around. Not because dividends change or even profits vary that much, but the perception of how much we're going to pay for a dollar of profits does vary depending on what's going on in the market. And right now, we're kind of middle ground. 18.3 at our last reading on this measure. The long-term average in the post-inflation era is about 17. So it's not back up the truck, we got to buy every stock we can see. It's not hide under the bed either. It is really telling us to find a balance between offense and defense, which feeds into theme 2. Stay strong on defense. Sounds kind of corny. Why wouldn't we? Of course we would. But our observation is that Canadian portfolios in general, and we have some planners in the room, I'd be interested in their views after, is that the safe part of Canadian portfolios has got less safe over time. We're all sick of going to the bank and getting almost nothing for GICs or buying a government bond and getting very little yield. And so what have we done? Well, or not we, but Canadians in general, moved up the risk spectrum. We've bought more risky bonds, structured products, preferred shares, even replaced bonds with dividend stocks. All perfectly good asset classes to do, but think about them. They are all much more tightly linked to the ups and downs of the stock market, whereas high-quality bonds goes the other way. When stocks go down, high-quality bonds go up in value. So we have very much at this stage, we love to play offense in the income fund, and those of you who hold it for a long time know it's had a great return over 13 years, but right now we don't think it's time to play offense in fixed income. So Connor Clark and Lund, our manager, is our first strategy around doing this is this light blue piece of the pie at the bottom, corporate bonds, has been dialed down considerably from where it usually is. It's about a third of the fund. At times it's been well north of 50%. And the bonds in there are very, very high quality at this point. And you might say, well, why not? We need more yield. Come on, grab some more yield. But their assessment is that to get that extra yield, we're taking too much risk. And so we're willing to kind of sit on the sidelines, let some of what we think is some pretty foolish practices going on in the debt markets right now, kind of watch that from the sidelines with the idea that, number one, it'll help smooth our returns out, and number two, we think our fixed income returns will actually be higher as we go forward through the next 2 or 3 years. So that's the first thing we're doing to keep our defense strong. The other one is specific to the Founders Fund. And if I go to the bottom of that SAM chart this time, you'll see that we don't own a full slug of bonds. And now some of you have given me a really hard time about this. Tom, why do you have cash? Why don't you have more equities? The cash isn't a substitute for equities. As you've heard earlier, we're fully invested in stocks right now. It is a substitute, however, for bonds. Because as much as CC&L is doing their job, dialing down the risk in bonds, we like to have that diversity because cash, which is things like, it's in our savings fund, things like treasury bills, commercial paper, high quality short-term bonds, aren't as volatile. They're yielding about the same, but they don't have the same upside, which is a drag sometimes, but they also don't have the downside. So it's part of what we call keeping the defense strong. Why do we do that? Well, right now we also want to play offense, and we're excited about this because on this side of the ball, we think we've got some tailwinds starting to develop behind us, and I'll explain why. When we look at the stock market, and Salman and I and the managers look, you can carve the market up in any number of ways. But this is probably the most common. Growth on one end of the spectrum, value on the other. So the growth companies are things. These are the stars of the show, the FANGs, as Magnus referred to, Amazon, Google. But a whole bunch of other companies that are growing faster, but also are more expensive to buy because of that. On the other side of the spectrum, some perfectly good companies, but growing slower. Some of them would have warts on them, had a tough quarter, bad product launch, as I mentioned earlier, and so they're trading at much lower valuations. So over the last 11 years, the growth end of the spectrum has absolutely smoked value 10 of the 11 years. It has been one of the great growth winning streaks of all time. And you might say, well, why wouldn't growth always win? They're better, they're growing faster. Well, value in the history of the last century or so has actually won that race. Why? Because you pay less for value stocks than you pay for growth, and growth can be a little more fickle at times, but not in this last 11 years. So why will that end? Why would we feel like we have a little better of a tailwind for a style like ours that's more methodical, more valuation driven? Well, we don't know for sure, but we do know that the valuation on growth stocks, which is the red here, this is the price-earnings ratio, that same ratio we used before, has headed straight up really since the last crisis, whereas value in blue is much lower. And so that gap is as wide as it's been. It's really only been this wide once before, and that was in the late 90s during the tech boom and arguably the tech bubble. And so could it go higher? Maybe. Could it stay there for a while? Sure. But we do think that it is creating just tremendous opportunities to buy companies that maybe aren't quite as growthy, maybe have stumbled a little bit, but we think are going to generate good returns going forward. So how does undexing fit into this value spectrum? Well, we're all across it. We don't ask any of our managers, we don't ask Joe or Magnus to be growth or value. They can go where they find the best opportunities, but they do have tendencies. So our equity fund is kind of center to over to the left. They get their giggles from buying growth companies, so they're probably a little more to the growth side. Our global fund, which has been the one that has struggled, you sort of understand a little bit why now, because it is more on the value end. Joe and Magnus's funds are a little more balanced, but tend to be growthy when they can be. So if we get this shift, when we get this shift to value, how do we benefit from that? Well, we know, first of all, that our global fund will stay over there. And believe me, Anne is excited because the opportunities she's finding in the global fund are better than she's had since she started to manage it. The other thing, though, you heard from our two managers, I think, and we certainly, or at least Joe, and also in our equity fund, is we have been moving more that way. They'd love to own growth stocks, but right now, things like OSHKOSH, I think Joe added 7 new names in a small cap fund last year. I can't categorize any of them as hot growth companies. They're good companies, good franchises, but have stumbled and created a really good opportunity to buy them as value investments. So when we pull this together, the philosophy, what Salman talked about with the managers, these strategies, guess what we're trying to tell you is that we're going to stick to what we're doing. Undexing, we think, is great for all seasons. Doesn't always work, we're not going to lead the pack every season, but we think when we come out through a year and many years, it'll work. Partly because I think we're pretty good at looking through that noise and hopefully helping you get through that noise as you worry about some of the issues we've talked about tonight. The process is anchored totally on valuation. Many of us can find a really good company or cool company we like, but you've got to buy it right if you want to generate an attractive return over time. So it influences not only the stocks we buy and the bonds we buy, but also how we allocate capital in the Founders Fund and the Builders Fund. And finally, we're not overly pessimistic, but we do think on the defensive side of the ball, we do need to keep strong. And so we are sacrificing a little yield, but we think it sets us up longer term to generate smoother and better returns. So I'm going to stop there and give Lori the mic and the clicker and let her bring it all home. But thank you.
Okay. So you've heard a lot of information from us. We've talked about our philosophy, the funds, some of the companies we own within the funds, and a few of the opportunities that lie ahead of us that we're pretty excited about. Everything that you've heard from Tom and Salman and our managers today, this is the core of what we promise to deliver you as an investment firm. But it's not the only thing that we promise to deliver you, and the clue is in our name, Steadyhand. Some have called it quirky, but Tom and Neil chose the name Steadyhand very deliberately. It's pretty simple. We want to live up to our name. When we think about how to achieve better returns and outcomes for you, fund performance, of course, is a key component, but the level of advice and guidance and service, or steady hand, we provide, we think is just as important. For many people, investing is hard work. It can be complex and unfortunately sometimes intimidating. And emotions, and this is a big one, can cause us to make decisions around our money and investments that may not always be in our best long-term interests. I think the industry has done a terrible job of listening to us, their clients, and our needs. When we meet with prospective clients, we don't ask you to complete an intake questionnaire or fill in a risk tolerance form. What we do is ask questions, and usually a lot of them. And we provide you the opportunity to do the same of us. We want to know your financial situation, and it's helpful, but more importantly, we want to know about you. What we find is most people's primary concerns aren't about the funds or performance or even the fees they're paying. It's more around the challenges or worries we all face in our lives, around work and health and our family, future, and whether we'll have enough money. So the past 50 minutes or so, we've really tried to give you an investment review of Steadyhand and the funds and the portfolios, but you may be sitting here with your own questions about your own situation and your own portfolios. And we recognize that the questions that you have will be different. They'll be based on the stage of life you're at and your personal circumstances. Many of you today are retired or hoping to retire soon. And planning for and settling into retirement, not just financially, can take some time getting used to. What you need from your portfolio and how your money is managed is very different from somebody just starting their financial journey or reaching a life milestone like getting married or expanding their family. Bringing all of these pieces together, your financial situation, the stage of life you're at, your concerns, how and where you want to invest in your goals, that's what we do with and for you. For some of you, you may have more complex situations and we'll refer you to an independent financial planner or other professionals. But for most of you, the more we know about you, the easier it is for us to give recommendations specific to you and for your family. With so much going on in the world right now, we're really here to cut through the noise. And last week, Ann Gudafin, who runs our global fund manager, said, cut through the market shenanigans. But we're really here to do that for you, regardless of your situation or the amount of money that you have with us. So, those of you who've been here before know that we usually like to wrap up these sessions with some advice and maybe some to-dos. But this time, we're simply just going to offer you an invitation to reach out to us. So if you were hesitant to call before or weren't quite sure of the level of advice that we provide or don't know your SAM, it's okay. Call us. We can help you and we would love to hear from you.